Hi viewers, in this video we will be discussing the Unit 1 of Module Management Accounting and Applied Finance MAAF that is offered by CA Australia and New Zealand. In this video we will be discussing Management Accounting, PESTEL Analysis, SWOT Analysis, Porter 5 Forces, Ethical Principle, and their threats and safeguards. So before we go into the video, if you haven't subscribed my channel, you can subscribe it so that you can get updates regularly. So let's start with the management accounting. So just keep an eye on your CSG, the difference between management accounting and financial accounting. The first difference is its purpose. The purpose actually, the management accounting serve the purpose of the information to decision makers who fulfill an organization goals and objectives. While on the other hand, if we see the financial accounting purpose, so its purpose is to communicate organization's financial position to investors, banks, regulators, and other external parties. So in the same way, if we see the users of the management accounting and financial accounting. So management accounting have internal users such as managers and decision makers within an organization. While on the other side, financial accounting does have external users such as investors, banks, regulators, and suppliers. So now if we come to the third point, that is focus. So future, not past. So in the management accounting, actually, we are forecasting some things. So it is future oriented. While on the other side, if we see the financial accounting, that is actually past oriented. So, and when we come on to the analysis focus, so actually, its major focus is on analysis. Like in the management accounting, we do the analysis. While on the other side, in the financial accounting, we do not analyze, we just present the information that we get it from the management accountants. And if we come to the no legislation or standards, so then the management accounting does not have actually any legislation or any standard as like the financial accounting. Financial accounting does have standards, as we can see the IFRSs. And the timing. So actually the time span, it may vary. It might be 15 to 20 years and include financial and non-financial reports and everything. But the financial accounting does have mandated reporting periods, primarily on the company as a whole. Now, if we come to the next slide, that probably help us to the process of management accounting. So it does have the stages of management accounting. So it has 5 stages, if I say. So what are these 5 stages? We will go and have a look on that. These 5 stages, the first stage is understand the business information requirements. Understanding the business information requirements. The second is gathering information. Third, analyzing and interpreting information. Fourth, drawing conclusions based on analysis. 5, presenting information and making recommendations. Let's dig one by one each stage so that we can understand it so easily. That will keep us to remember this thing. So understanding the business information requirement is actually what is actually required by anyone who is looking for us. It means a strong understanding of the organization and its operations, good relationship with decision makers and management, and understanding of the different type of activities that management perform and the information required to support those activities. So if our manager, being a management accounting, if our manager is asking for some information, So definitely, first of all, we have to understand the system and operations of the organization where we are working. So that is the first thing. That is the first stage for the management accountant who is preparing any kind of report. So now if we dig into the second step is actually gathering information. So what is gathering information? So definitely, as we know, it might be internal source or external source. So we have to gather information to give or to prepare or to analyze any report or interpreting any report. So that source can be internal source or external source. If it is internal, then it might be from IT system data, production data, sales data, financial reports, anything. But external data, external sources can be market competitors and environmental analysis. And just keep in your mind, once you are thinking about what needs to be considered if you're gathering information. Information must be easily obtainable, it must be reliable, it also meets stakeholders' requirement, it should not information overload. Yes, these are the four things, yes, that you have to keep in your mind when you are gathering the information. So you have to consider these 4 points. So now come to the analyzing and interpreting information. The third point. Use analysis tools and techniques. Definitely, if a management accounting accountant is preparing any kind of reports, he definitely will be using a lot of tools or a lot of techniques that he will be using to analyze and interpret the information. So what are those tools? So I'll be just giving you a couple of examples as like net present value, NPV, product profitability analysis, cost volume profit, CVP analysis, benchmarking, and their ratios. The other thing is SWOT analysis, target costing, value chain. So these are a couple of techniques are that needs to be followed. So if we come into the fourth point, that is drawing conclusions based on analysis. So definitely whatever we have done before, like if we have analyzed and interpret the information, definitely our main purpose is to conclude that information, whatever we have done. So because why we are concluding the information? To make it presentable, that's the last step, to make it presentable to our stakeholders according to their needs. So definitely the fourth stage that we can say, drawing conclusions based on analysis, like consider financial consequences and non-financial consequences. Just keep in your mind when you will be asked in the question, you don't need to just analyze the figures. You have to also correlate all those figures or amounts or the financial data with the non-financial information that you will be provided, you will be given in the exam scenario question. And now, if we come into the presenting information and making recommendations, this thing is very important. Presenting information so that if you're presenting any information to anyone, definitely it must be your stakeholders. Then what it should have to make your presentation very good. So it should have three things. It can be easily understood. It is concise. It is relevant to the decision. Okay. And the other thing is, because you are making information to the stakeholders, so then what are a few things that you have to consider or you have to make in your presentation a little bit more impressive? So it should be, the information included needs to be accurate. The information must need to be accurate. It should be cost effective to obtain. If you are recommending anything, it should be cost effective to obtain. It should be consistent with routinely reported. a lot of report the management accountants prepare. These are routinely reports. And timely to be useful. It can be used timely manners. Now, if you see, the presentation methods can be financial reports, written reports, traffic light reports, so balance scorecard. These are a couple of things that you can, presentation methods could be when you will be presenting or recommending whatever you have your analysis in the previous stage were. Let's move on. So now this is SWOT analysis. As in the previous slide, we were discussing the SWOT analysis. What is SWOT analysis actually? SWOT analysis is like, it is actually strengths, weaknesses, opportunities, and threats. If you see strengths and opportunities, these are positive aspects of an organization. But weaknesses and threats, these are negative aspects of an organization. But if you see the other side of the SWOT analysis, strengths and weaknesses, we can, like, these information, strengths of the company, weaknesses of the company, these can be obtained by internal analysis. You can understand this thing. Okay, it can either be value chain analysis, it can be resource based view or BV. Okay, but SWOT analysis, the second part is opportunities and threats. These two things, like what opportunities are available, can we find it within the organization? No. Or the threats, can we find it from within the organization? No. These are the information, opportunities and threats can only be obtained externally. So just as like doing the PESTEL analysis or Porter's 5 forces analysis. So if we see the SWOT analysis, so with the strengths, how can strengths be used to exploit opportunities? So we have to think about this thing. Like strengths, exploit to gain competitive advantage. Like sometime for any organization, they will be asking what are their strengths. It might be sometime competitive advantage. It might be sometime their processes. It might be sometime if they're producing anything, so the other industry or they are leading in the market, so this is their strength. On the other side, if we say weaknesses, so weaknesses are actually, they may restrict an organization's performance. These are weaknesses. Supposedly, they will be saying in the scenario of the examination, like recently manager has left or just because of some kind of dispute with the higher management. It can be the weakness. Like what other things that need to consider, that's a problem or anything that can also be threat. And opportunities have the potential to help the organization achieve its strategic vision. Opportunities mean like what are the external factors that are available to the organization by which they can get um, a lot more better results or a lot more good profits, or they can serve the community in a very efficient manner. And the last factor is threats. It may prevent the organization from achieving its strategic vision. So for any organization, if anything, any hurdle, any threat, or anything that is preventing the organization from achieving its targets, from achieving its strategic vision goals, so it means it is threat. And how can strengths be used to reduce the risk of threats? So definitely, risk of threats, we can to mitigate the risk of threats by using strengths. But how, that we need to answer in the exam. just keep in your mind value chain analysis and resource-based view that we will be discussing in the next couple of slides. And the PESTEL analysis and the Power of Five Forces also will be discussed later on. Now, the strategic decision making, the business strategy. The business strategy is actually a combination of all those four internal and external factors that we have discussed previously in SWOT analysis. So, what those for two internal and external factors, but the business strategy has value chain analysis, resource-based view, PESTEL analysis, Porter Five Forces analysis. These are the strategic decision making. Analysis of internal factors organization can control. Analysis of internal factors. As I told you, the value chain and resource-based view of the organization, these are the internal factors that organization can control. Definitely, value chain that can be controlled by organization. The first thing is value chain. Porter suggests in the order to determine strengths and areas of competitive advantage, an organization should analyze its generic value chain, segregate all the activities it engages in. And so this will be actually will be discussed in more detail in Unit 3. So just don't worry about thing. Resource-based view of the organization. Identify the resources that the organization has. What are the resources that organization have? What does it mean? The tangible, physical objects, cash, plant, technology. These are the tangible organization resources. So resources, the resource-based view of the organization is resource. What resource does they have? Does the organization have? Like the tangible, intangible, organization capabilities. These are the three things, three resources, if I say. So what are the resources? Tangible, intangible, organization capabilities. If it's tangible, definitely it can be touchable, physical object. Intangible, non-physical assets, strong brand, experienced staff. Organizational capabilities are actually organizational processes that turn inputs into outputs in a superior way. Example, very efficient manufacturing, outsourcing, outstanding customer service. Now, to the second step, see whether the resources forms the basis of competitive advantage. So because we are doing the resource-based view of the organization, so it means we are definitely looking into competitive advantage. Strategically important resources have 5 characteristics. So what are these characteristics? Strategically, like these competitive advantage does have 5 different things or 5 characteristics. What are these characteristics? These characteristics are valuable, rare, difficult to copy. So because they do have a competitive advantage, so that's why these characteristics, like that resource, the above resources that we have discussed, tangible, intangible, organization capability, this should have these characteristics so that we can say the organization have a competitive advantage on any other organization in the same sector or in any sector. So one, these things should be valuable, these things should be rare, these things should be difficult to copy, these things should not easily substituted. Okay, cannot be substituted by anything. These things usable. Okay, so just keep in, just I'm giving you overview of the value chain. This value chain is like, this can be the internal factor. We can understand the strength and weaknesses, because as you remember in the SWOT analysis, when we will be doing the SWOT analysis, then we need these internal factors. So what their value chain is, so we can analyze its generic value chain, we can segregate all the activities and engages in. And the other the other method is resource-based view. So what are the resources that the organization have, and what are the competitive advantages based on these resources does the organization have. And also, I will be discussing what is in the internal analysis. Definitely, the value chain analysis will be discussed more in a more deeper manner in Unit 3. And the resource-based view, that is RBV, it does have two steps. So identify the resources, and the second step is apply a series of tests to each resources, which are like applying these 5 characteristics tests, or these questions that you have to ask, so that you can identify so whether the organization have the competitive advantage or not. And analysis of the external environment now, because now we're heading to the external environment thing. With the external environment, external analysis may be divided into 3 main areas as follows: business environment, competitors, customers. When it comes to preparing the external analysis, so then we discuss the PESTEL analysis and the 5 forces, Porter 5 forces. These are not within immediate control of the organization, so we cannot control, like the organization cannot control these things. So just you just need to analyze things, whatever you want to do, but you can't control these things. As like the PESTEL analysis, consider the factors that are most likely to change and impact on the business. So just in the exam question, so if they will be asking about SWOT analysis or any kind of analysis, or strategic weaknesses, or anything they want to identify, then just keep in your mind, like, these are the couple of factors that you have to consider as well. Even though it's the external factors, but definitely you can discuss in your question by answering that, like, these are factors, or like one of these factors, as like political, whatever it is, economic, social, technological, and environmental. So that is PESTEL actually. Political is prevailing political conditions and policy, like trade restrictions, taxation policy, political instability, anything that can impact externally to the organization. So these are the factors that can, these are the political thing, or the elections that can impact the organization if it's in the area where the elections are happening. And the economic, interest rates, exchange rates, inflation, etc. This is the economic factor that cannot be controlled by the organization. Social, demographics, consumerism, lifestyle changes, and social mobility. As like if anyone who is living in Melbourne, so the demographics is social. So Melbourne is more social as compared to Melbourne and Sydney, or these are the big cities, and also these are more social as compared to the other one. We can say it like that, for example. And technological rate of innovation, technological obsolescence. So these are the as we can see how this technology and blockchain and these kind of things are impacting our any organization so fast, so that like even we have like these are the things that cannot be controlled by the organization. So technological things that can impact the organization in any way. Environmental, waste, global warming, environmental issues, these are the issues that we have to cope up with. And now come to the Porter 5 forces analysis. In the Porter 5 forces, so there are like the 5 forces. What are these 5 forces? The bargaining power of suppliers. Bargaining power of suppliers. So these are the bargaining power of suppliers, like the differentiation of inputs, supplier concentrations, presence of substitute, relative size. So this is the bargaining power of supplier, but like it means how much they can bargain. And the second is threats of new entrants. So these are the things that you have to ask, like whether do they have the bargaining power of suppliers? Uh, uh, how important or how strong the bargaining power of supplier is, that you have to ask this question while doing the analysis, while doing the SWOT analysis, while doing the strategic analysis, Porter 5 forces analysis. So you have to ask this question. So if the suppliers are more powerful in the bargaining power, so it means the organization will not have any kind of strategic competitive advantage. And the second thing, threats of the new entrants. So these threats always exist in the economy. And so definitely if an organization does have the competitive advantage, so this risk really is negligible. And economies of scale, so it means the threats of new entrants means the brand identity, as like we can say the Apple, and capital requirements, and a couple of more things as well. And the third thing is rivalry um, among existing organization, industry competitors. So industry growth is more important. Concentrations and balance, intermittent overcapacity, exit barriers. Third thing is, this was the third thing, rivalry among existing organization. And now if we see the fourth thing, the threat of substitute products or services. So substitute products, how easily the substitute products can be available for that product. If it is easily available, as like the Coke and Pepsi, so it means they are not competitive. They does not have competitive advantage in the industry. Um, which actually it doesn't even exist in this organization. A lot of things can be substituted, but definitely it's upon the quality and thing that the consumer, how the consumer goes, and the bargaining power of the buyers. So now that's the thing. So the buyer's power is more important than this thing. The buyer concentration, substituted products, price sensitivity, how sensitive the buyer is towards the prices. If we increase the prices, does it impact to the buyer or not? So these are the things. Now, if we go a little bit more deeper into the generic strategies, the generic, like the Porter generic strategies, these generic strategies are based on actually three things. Three generic strategies are: one, cost leadership; two, differentiation, how different the product is; third, focus or niche. So just when we will be analyzing this figure that is in front of you, this diagram, so then we will be considering these three things. So here, if you look into this on the x-axis and y-axis, in the x-axis you can see the lower cost leadership. So it means all these side things, like these will be low cost leadership. And in this area, the differentiation in the x-axis, so this will be differentiation. These area will be the differentiation. Now, if we see in the y-axis, the downside, that is a narrow or niche. So they will be focusing, or their market or the target market will be narrower. It will be narrower as compared to the other market. Now, and here in this area, it's broad. This will be broad in terms of category, in terms of target market. So now if we discuss one by one individually, if we start with this one, uh, so if we start with this one, broad low cost provider strategy. This is broad and low cost provider strategy. What does this mean? So this will be provided, the target market will be broad, but the cost will be lower. So it means appealing to a broad spectrum of achieving a lower cost structure than its rivals. For example, we can say Woolies, Walmart. These are the example of that. Now, move on to the second one, broad differentiation strategy. What is that broad differentiation? By offering a point, so it means this will be broad, like the target market will be broad, will be offered to a lot of people, but the cost strategy will be, or even we say it's this strategy on the x-axis is a differentiation. So the differentiation in product, broad but differentiation in strategy. So it means by offering a point of difference around products or services that is different from its rivals and appeals to a broad spectrum. We can say the example of this one is David Jones, because it does have the broad differentiation strategy. And now come to the third one, best cost provider. Let's say we will discuss this thing later on at the end. And then we go to the third one. The third one is focus low cost strategy. This is focused to some niche, some market, but this is a little bit more narrow, but this is low cost as well. So it's by achieving a lower cost profile than rivals, and that is focused on delivery to a narrow band of customers. Um, so what is the example? What do you think of? This example is, we can say it IKEA, the furniture. And now, if we move on to the fourth strategy, that is focused differentiation strategy. That focused differentiation strategy is actually by offering a point of difference to customers that appeals to a narrow band of customers. It means the differentiation, but it has a narrow. It's not broad. So just keep in your mind, it's not broad, but differentiation. It's narrow and differentiation. What is the example of that? It's R.M. Williams, clothing and footwear. Now, suppose if we come to the best of them, best of these strategies is the fifth one. The fifth one is best cost provider strategy, which does have the characteristic of all of these four. So what does it mean? Providing excellent value to customers by offering high quality goods or services to customers at a lower cost profile than its rivals. What is the example? What do you think of? Its example is Bunnings Warehouse. Now let's move on to the so definitely we will be thinking of how the cost leadership can be achieved. The cost leadership can be achieved, an organization can achieve cost leadership by doing few things. What are these things? So the high asset utilization rates, they can use their assets in a very efficient manner so that they can produce, or they can produce the goods in a more efficient and a very good way. And standardizing its products means using the same components in multiple products and limiting the variations and customization of its products. Third point is using automated and efficient processes, having efficient supply chain, controlling its overhead costs. So these are 5 cost leadership points that needs to be remembered when reading the low cost leadership strategy. Now let's move on to the fundamental principles. That is almost our last topic, but not least. Fundamentals ethical principles. What are these? So these fundamental principles are actually in para 110.1A1, integrity, subsection 111. So integrity means honesty, if I say, just straightforward honesty. To be straightforward and honest in all professional and business relationships. So this is what happens is actually the background is if any ethical dilemma happens, then there are a couple of key ethical issues that comes during the job. Then what we have to do? Then the organization provided us with the key fundamental principle at risk. If any kind of risk happens, so what we need to do? If any these kind of risk happen, then we have to risk mitigation strategy that we can say if any kind of threat arises, then we have to apply the safeguards. To whom this apply? If you are a CAANZ member, then yes, it applies on you. If you're not a member, then it doesn't apply on you. If you're a member and you're a member in a business, then code parts parts 1 and 2 apply if you are a business member. And if you are in a public practice, then code para 1 and 3 applies to you. Now come to the integrity. Integrity to honesty, that already we have discussed. Objectivity. Objectivity is actually to not allow bias. Objective means it's the biasness. An accountant or management accounting, any person who has done these studies should be ethically unbiased. So he does not need to have a conflict of interest or undue influence of others to override professional or business judgments. Professional competence and due care. Now the third point is professional competence and due care. To maintain professional knowledge and skill at the level required to ensure that a client or employer receive competent professional services based on current development practice, legislation, and techniques. So what does it actually mean? Competence. So that person who is providing the professional services, professional advice, he need to be professionally qualified, even if say, and does have the proper knowledge of the industry, and it does have the proper practice, and it does have it have to he must have known to the development in practices like the CPD hours. He has done the CPD, and also he know the legislation and techniques and act diligently and in accordance with applicable technical and professional standards. So this is actually the professional competence and due care. Confidentiality is like this is the responsibility of any professional advisor. Like they have to keep the client's data and information confidential. To respect the confidentiality of information required as a result of professional and business relationships, and therefore not disclose any such information to third parties. We don't need to disclose the information to any third parties without proper and specific authority. But there is one exception to that. There is a legal or professional right or duty to disclose. And now come to the professional behavior. The professional behavior is to comply with relevant laws and regulations and avoid any action that discredits the profession. This is, now we will be discussing the ethical threats and safeguards. So definitely, if someone who will be facing any kind of issue, any kind of if someone who received a bribe, so what do you have to do? Then we have to discuss this thing in a little bit of detail, like threats to what are the threats to these above mentioned fundamental principles. So if it's financial or other interest thing, then it should be the self-interest. Okay, this is the threats. So these are the categories, like the 5 categories: self-interest, financial, it can be financial or any other interest, self-review. So if not appropriately evaluating the results of a previous judgment made, it's if someone who has also reviewed will be reviewing his own thing, then definitely he could not be able to review it as other person would have done it. Advocacy, promote a position to the point objectivity in compromise. So advocacy, if an accountant is an advocate of something or representing something, then definitely he will not be able to make the information wrong because he have previously advocated the client. Familiarity, long or close relationship of the client make the client familiar with the accountant. Intimidation, actual or perceived pressure, and any kind of pressure, actual or it might be perceived pressure, including attempts to exercise undue influence. Now, what we will be doing with the, so if any person has faced threats, what are we doing? We will be applying the safeguards that are given in 120.10A2 safeguards para. Actions or other measures to eliminate or reduce threats to an acceptable level. Safeguards created by the profession, regulation, or legislation. So these are the safeguards created by the profession. And safeguards in the work environment that needs to be applied. Suppose if you like our channel, you can like it, and then definitely we will be discussing the exam questions at the end of third unit, so that these can be, you got enough time to revise. So if you haven't subscribed our channel, you can subscribe it now so that you can get notifications. Bye for now. Let's see in next lecture.